Alright, let me break this down. Deutsche Bank just dropped their Q2 results and the numbers are making headlines. Record post-tax profit of 1.9 billion euros, up 10% year-on-year. But here's what I find fascinating. This isn't just about profit growth. It's about how they're doing it and what that says about the future of banking. Let's dive in. First off, the CEO mentions AI as a value driver. Wait, AI in a traditional bank like Deutsche? That feels counterintuitive. Most people associate AI with Silicon Valley disruptors, not legacy European banks. But if they're scaling AI to cut costs and boost client services, that's a bold pivot. Personally, I think this signals a bigger shift. Traditional banks scrambling to avoid obsolescence. The question is, can they innovate fast enough without alienating their core client base? Now, let's talk about their global Hausbank strategy. They're touting growth in assets under management, 1.9 trillion euros now, with 135 billion euros added in Q2 alone. But here's the thing, that growth isn't just organic. They're closing branches in Germany while expanding in wealth management and tech. That duality fascinates me. On one hand, they're cutting physical infrastructure. On the other, they're doubling down on digital and global investments. It's a high-wire act. If they misstep, they risk losing local trust without gaining digital traction. The investment bank's 36% revenue surge is another head-turner, fueled by fixed income and capital markets. But let's not get too excited. That's a volatile sector. Markets can turn on a dime. What's more telling is their 16.4% ROTE in corporate banking despite interest rate headwinds. That resilience matters because it shows their bread and butter business isn't just surviving, it's adapting. Then there's the elephant in the room, sustainability, 523 billion euros in sustainable finance since 2020? Impressive. But let's read between the lines. Transition finance, like that 100 million euro grid loan, is smart PR. It positions them as eco-friendly while still profiting from traditional sectors. However, as a skeptic, I wonder, how much of this is genuine impact versus greenwashing? Their own report admits validation delays, meaning some projects might not meet ESG criteria until after they're counted. That's a red flag for accountability. And the CET1 ratio, 13.9%, right on target. They're buying back shares, signaling confidence. But here's the catch. Their forward-looking statements list risks like market volatility and borrower defaults. Translation? This rosy outlook assumes no black swan events. In 2026, with global politics and inflation still shaky, that's a gamble. So what's my takeaway? Deutsche Bank's playing a tricky game, balancing cost-cutting with growth, tradition with innovation, profit with sustainability. Their success hinges on execution, especially in AI and ESG. If they pull it off, shareholders win. If not, those record profits might become a cautionary tale. What do you think? Can legacy banks reinvent themselves, or are they just delaying the inevitable? Let me know in the comments.